Assalamualaikum warahmatullahi wabarakatuh. First of all, let me introduce myself. My name is Diah Ramadhani, student ID number 23412060 from class Akuntansi 23A. On this occasion, I will discuss the examination of short-term liability, a crucial component of a financial statement audit. Short-term liabilities are company obligations that must be paid in less than 1 year. Example includes accounts payable, salaries payable, interest payable, tax payable, and the current portion of long-term loans. Examination of this account is crucial because it directly relates to the company's liquidity and the potential for errors in the recognition of liability that could impact the fairness of the financial statement. According to PSAK 1, short-term liability are obligations expected to be set within the entity's normal operation cycle or within 12 months after the reporting period. Types of short-term liability include account payable, notes payable, salaries and wage payable, interest payable, tax payable, and unearned revenue. Due to their immediate maturity, these accounts are highly susceptible to recording errors. Audit need to understand each type or liability to assess whether their recording and presentation are in accordance with applicable accounting principles. The primary objective of the short-term liability audit is to ensure that all liabilities have been fully recognized, are correctly amounted, are owned by the entity, and are correctly present in the financial statement. The auditor must also ensure that no liability have been owned or concealed, and that the recorded liability to truly the responsibility of the company. Thus, the audit result can provide assurance that the company's financial position fairly reflects its short-term liability. In conducting an examination of short-term liabilities, the auditor performs several key steps. First, the auditor examines supporting documents such as supplier invoice, purchase contract, or proof of goods received to verify the existence and amount of account payable. Second, the auditor conducts direct confirmation with supplier or creditor to ensure that the recorded balance to account payable agree with third party records. Third, the auditor reviews subsequent payment to ensure that liability paid at the beginning of the following year actually exists at the end of the reporting year. 4. The auditor conducts an analytical review between the current year and the prior year to identify any unusual fluctuation. Finally, the auditor examines disclosure to ensure that all liabilities are adequately described in the financial statement. Auditing short-term liability often faces several challenges. One of the main ones is the risk on credit liability, which occurs when a company forgets or intentionally fails to record certain liability to improve its financial statement. Another challenge is misclassification, such as a long-term liability that shall be classified as short-term. Furthermore, auditor must be wary of manipulation of the timing of transaction recognition, such as reporting the recording of debt to a later period. To address this, auditor must exercise professional skepticism and ensure that all liabilities are recorded in the correct period. In conclusion, the examination Short-term liability is a crucial part of a financial statement audit, aiming to ensure that all short-term liability are recognized, valued, and presented fairly. Through audit procedures such as document review, balance confirmation, trend analysis, and post-balance sheet payment testing, auditors can detect error or fraud in the recording of auditors can detect error or fraud in the recording or reliability. Very careful auditing and adherence to the principle of professionalism. A company financial statement will accurately reflect its liquidity and short-term liability and be credible to stakeholders. That's all the material from me. Thank you. Wabillahi taufiq wal hidayah. Wassalamualaikum warahmatullahi wabarakatuh.